Fine? Okay. The last one, relative valuation, I think I have to go a little fast. We know relative valuation, right? Where you compare earnings to, say, sales, earnings, right? Market. So the basic philosophy is intrinsic valuation is difficult. So I will not do difficult path, I will do easy path, right? Which is relative valuation. So for relative valuation, you have to do, first you have to find identical companies. You should not do P ratio comparison of a EPC company to FMCG company. Idalam panna gross mistakes. Then you pick up a measure. It could be earnings, book value, sales, any of the metric, right? And it's easy to compare, right? So you can quickly spot one stock is cheaper to other stock. If all parameters are equal, the lower the PE, the better, correct? The higher the PE, it's not better, right? So relative valuation is the valuation which lot of people use every day. Sometimes you use intrinsic or EVA, but predominantly this is used. Why? It's faster, it's convenient, it's easy to measure, but it has its own pitfalls. So advantage is simple. It's much likely to have perception. A lot of perception will have effect on the relative valuation. There will be always a significant portion of security will be undervalued. So even in September 2024, absolute valuation ellame costly. On a relative valuation, sila stocks cheaper. So from fund management point, it's always relative is used. Why? At least you will find this name is cheaper than that name. But you do DCF, no. Every name is costly. And you don't have to do explicit assumption. The best part of relative valuation is you don't have to find terminal growth rate. You just have to ask, in the PE irundhudana enna terminal growth rate irukku vena nama kandupidikalam thavira, you don't have to do the hard work of finding terminal growth, which is also very, very difficult in nature. But the disadvantage is there. A portfolio composed of stocks which are undervalued, but relatively it could be fully overvalued. It means you still can buy an undervalued within an overvalued market. So those who have lost a lot of money in the last 4-5 months, thinking I bought cheapest stock in the market, but the entire market was expensive. So we all lost. Somebody lost more, somebody lost less. Implicit assumptions are made with other variables which we don't know. Number modan theriyumla, we don't know what is the free cash flow, what is the discount rate. So what we assume is market knows everything. So we are believing market now. That is also bad. So relative valuation, when not used effectively, also will hit us. But this is far easier to use than the absolute valuation. So there are 6 basic metrics used in relative. PE ratio, which we use every day. Someone asked Nifty PE, which I'll come in some point. PB, price to sales, price to embedded value. Enga use pannuvom? Insurance la there is nothing called PE, or it's called embedded value, and nobody knows what is that embedded is. It's very difficult, no, because it's actuarial science. Avanga kudukra value computation pandradhu nammala mudiyave mudiyadhu. We just have to take the value on face value. EV by EBITDA, replacement cost, typically cement companies kalam பண்ணுவாங்க, or mining companies ku பண்ணுவாங்க. Finally, price to cash flow. So I think we all know this, what is PE ratio. I don't want to use it, but this has to be used for a stable, profitable company. Remember, you use a PE ratio for a non-stable like a Tata Motors or a loss-making company, the number will be all over the place. So we all know PE ratio, but how do we use PE ratio to make good judgment? We open the screener, we see the PE ratio, and we buy, correct? Most of us? It's good. There is a better version is what I want to tell, because that we all know, right? The better, one of the version which we use is, we do quartile analysis. Like what Subhash told, take a 20-year data of PE, sort it left to right, do the quartile division. In this case, we have divided the quartile into 5. This is the lowest PE the stock traded. This is the second quartile. It means most of the time, the stock traded between 19 to 23. Do you agree? And exceptional time, the stock went to 45. Think about, no, 11 PE, 45 PE between 22. Ingiyum trade agala, rumbo. Angiyum rombo trade agala, middle than trade aachu. So you have this data. The average is 20. right? So we say 20p irukku paathukalantu. So we invested when the close to 18, 19, this was a live example, but we did not sell at 22 because the growth rates were improving, the terminal growth was improving, the ROC was improving, the beta was going down, the discount rate was going down. So we saw this time the stock can go to 30p, but we don't know, right? So we stayed invested. And what happened is the stock, this is a large cap nifty stock, moved from 4,000 to 12,000 in a period of 2 years. Can you imagine? It's a nifty stock. Concept is important. Right? This stock, after 25p, right? There are people who sold off. One of the questions I asked, this company always traded an average multiple of 20 to 25% premium. On the premium, I should sell. But I said, fine. There are things are changing. You can be a little more pauseful. Luckily, they have executed extremely well. The stock hit what P? 45p. We never imagined. But you should know when 45 coming or 40 coming, right? This company never ever traded at this multiple. So you should do what? Slowly. So that's it what? As the price moved up significantly, consistent selling, and very luckily, I don't think it's planned one, we sold a bulk of us here. And then obviously, right, there was a lot of media interview. So one thing I can learn out of it, on the peak of the 12,000, the interview was super bullish, talking about a value 20,000 for the same stock, and everybody was super excited. But it's a very matured industry because ma'am has disclosed the product. The matured industry cannot grow at that rate. So the P moved from 45 to now 23, right? So valuation is a good tool for a good selling. So instead of using only averages, you can use the method of quartile analysis. You understand this analysis? Simply sort the PE, divide it by quartiles. Then quartile 0, 1, you buy, 3, 4, you start trimming it out. Normal distribution. Just order up pani avladha. Romba complicated la illa, very simple. My colleague only does it very sincerely for all the stocks for us. Okay, where rating applies? This is a very good company. This is a very good company. Yes or no? Cleaner ka growth pat P apply panla. This is like an HUL quality or slightly better than HUL. It's CRISIL. Annual report of 2024 got published 6 days back. So it's a time also not only read Trump annual reports, right? As usual, lot of good data are coming out from corporate India. Being an MNC, they have published it. In the company ke P apply panla. Inga P apply panlama. Steel company. Look at sales. This is a trailing. Every quarter I have done 12-month trailing. It means company reports 12-month result once in a year, right? But we can compute 12-month result every quarter because last 12 month நம்ம வந்து aggregate பண்ணிட்டே போலாம். This is trailing. So the trailing sales is always all-time high. But look at PAT, which used to be 13,000, 20,000, 3,000, 11,000, 3,000. PE எல்லாம் apply பண்ணோம்னா become very difficult. So stable, profitable companies PE should be applied. Very volatile company, other metric has to be applied. So this company PE will be always like 7, 8. Should we assume it's a cheap stock? Yes or no? Yes or no? Yes. A company profit stable irundadana PE stable irukum. Profit collapse aichina PE automatically shoot up aidum. So price to book is very similar to PE. Where does we use price to book? Basically, where, as my colleagues have told, denominator heavy, asset heavy, typically used for banks or maybe a loss-making company where you want to value in some form, you use price to book. It's coming. It's coming. PE expansion is the big slide. Just give me 10 minutes. Because that's an important point. How do we make money? Correct? It's coming. Just wait. So I'll just touch upon PB, we know, right? All the banks are used as PB. So this is HDFC Bank example. It used to trade at 4. Today it's trading at 2, 2.5. Obviously, it doesn't mean it's going to go to 4. But someone says the market is completely expensive. I don't think. There are some companies are trading at least much cheaper than the previous past. Price to sales, neither earnings Neither book value. Which type of a company? Exactly. Someone asked, right? Startups. So one metric is sales, number of customer they have. Again, I don't think as a public investor, I have a lot of leeway, but price to sales will give you some idea about how to judge it. Recently, one of the very first new age company we bought in, and there was a big debate about earnings all. I said, when the baby is born, now don't ask earnings all, boss. But there is a metric which is price to sales is what we use to value it. So price to sales is a decent metric, but big assumption is they'll make money at some point in time. Correct? So you need to be very, very clear why you buy. This should be the least used metric, but some company la idha mattum nama use panna mudiyum because they just born, they're reporting loss, they don't have balance sheet. Then you can't use either PE or PB. Rendume use panna mudiyadu. Correct? Adala, that's a given. Having understood the company is going to survive all that, right? You have to value an asset. And the point la varumbodhu, you can't use PE, you can't use DCF, you can't do PB. That's where PS comes in. This is the least used metric, hardly used in at least in our firms. But it's there. You should know, right? This is a very important metric. I learned it. I learned from one seasoned fund manager, and I'll show you one good example why sometimes we should be open to market feedback. Something called market opportunity size. Basically, market cap is too small for the opportunity it is addressing. And I'll share one example of a very known company called Bharti Airtel. How many of us doesn't know about this company? Please lift your hands. So I assume everybody knows. Can you imagine this company 6-7 years back traded at 1.3 lakh crores market cap. It's not very big, right? For the sales of 80,000 crores. But obviously that time the numbers were bad, correct? Look at the numbers. PAT 1,600 crores. Hardly they make any money. Debt to pathina 1.2 lakh crores. Kadan idukku mela irukku kadan. Return on equity and the subject illa, correct? 4%. Very bad. But what you know is the size of the industry is big or small. Are they monopoly or they will survive or not? If they die, what will happen to all of us? Is it possible? It will be a national calamity? 100%. Definitely government will step in, right? They can't allow Airtel to go bankrupt. Can they allow SBI to go bankrupt? Obviously, these things are not possible, at least. So, look about, one large industry, large player, we know it's going to survive. Vodafone Idea was going down, correct? Somebody actually took advantage of this situation and invested. And look at the learning. The next few years, the market cap has gone from 1.3 lakh crores to 10 lakh crores. Think what all has changed. Sales has doubled. PAT from 1,600 crores has become 22,000 crores. And debt is also around about same, correct? The interesting piece is, can we ever think about a large cap outperforming a small cap for a very long period? No. Why? Small cap should always outperform large cap, correct? Now see the data. Bharti Airtel for 6 years. 6 years, the stock is up 450%. 400 odd percent. This is small cap, this is Nifty. It's 2.5 times more return than the small cap index. Right? So there are two assumptions got broken. One, those who still believe only money to be made in small cap, sometimes the data doesn't support. Sometimes a very classic blue chip we will know in front of us. When you go to airport also, you know one company in front of us, you're always there, and a lot of money was made in last 3 years, correct? These are companies which is very, very clear winners, correct? So market size to the current market cap gives you a very good window. It will be very obvious. This is going to be a big company. You have actually found a good idea. So Bharti Airtel is an idea which happened, and I was surprised to see small cap index andalavu outperform ayirukku. No, I agree. I'll tell you. 3 months before that only downgrade happened to the ratings. But we also know Airtel cannot collapse. One, they had a good cash flow. They had a strong customer base. And you know, if Airtel were to collapse, right, it become one company because there is no BSNL, no Vodafone. So it's a question of, you could have waited some more time, but you are very, very clear. Number P ratio, price to book, ROC, that's the whole point. Sometime you have to sidestep and say, is this company will survive? Will they make money? Cash profit they are already making. And the stock was so cheap, it has outperformed the small cap index. That's the beauty about learning. I'm not saying on that day you can buy, but you could have progressed every 90 days, no? As the company survived, you would have seen the evidence and made a lot of money, correct? That is my learning here. So, I generally don't invest in company with low ROC or debt, but this gave me an example when there is a great company with clear leadership. I think sometimes you have to learn something. See, no, idea will not survive. No, 2009, no. See, no, you should always buy a winner. Obviously, the survivorship bias, but I'm saying, 2019 data, 2020 data, do you think Airtel will go bankrupt? What is your assumption? 100% no. That's all. I'll tell you, every equity investing is survival bias. India will survive. Agree or not? Correct? If you don't have belief that India will not survive, better let's take all the money and put in. Yes, sir. I think I'm short of time. Okay, yes. Okay, thanks. Correct. See, I'll tell you. Anybody, you have traveled abroad? Yes. What is the ARPU you pay if you travel abroad? And what is the ARPU you pay here? It's pittance. Very sure. The moment you step out of India, you pay 5x of ARPU. India is the cheapest. That's point number one. The largest guy with 50 crore customer is Airtel. Correct? Jio is good, can't match Airtel, at least in my south view, right? So you know the clear winner. Let's take Indigo, no? Those who have saw Indigo did not invest because Buffett told you should not invest in airline. But we all know you go to airport, there is only one aircraft. Which aircraft? Indigo. Whatever price they ask, you have to pay. So we know the answer, the company is going to make good. But that's why sometimes the most obvious investments are in front of us. So today when we have to tell, no, great large bank invest. Sir, that bank I know for 20 years. That doesn't matter, man. You're going to make a lot of money. Correct? That's all. Okay. So M&A method. So sometimes you don't have PE, PB all. You start looking at what is the private market transactions have happened. If you look at, interestingly, lot of general insurance nare transactions recent nadandhathu. So when you have in a listed company, right? You can also refer how private market is transacting this company and judge how well your company is cheap or costly. Correct? So this is something also we can use it from a valuation point. The last one, complex company. We spoke about simple company, correct? Easier pantu poidalam, DCF PE. But most of us choose complex company. Why? Not by design. What is the first thing we look at when you choose a company? First metric. Yaar sonada? No, it's natural. I see 50% of investors start from the end, correct? PE poidu. The moment low, you feel good. Yes or no? Let's be true to ourselves. You have to accept your truth. You don't have to tell me. So we start buying company which is slightly mixed. So the way to value this company is not PE, something called SOTP. So one example I brought in is InfoEdge. You know this company, Naukri.com? So they own Naukri, they own 99 acres. But I think they made big money in a company called Zomato, Tomato. We do a lot of stuff, right? So, company like this, we have to do something called SOTP. Every single business you value separately and you add up that company into one metric. So, let's take L&T. நீங்க L&T P எங்க போய் பாப்பீங்க ஸ்கிரீன்ல போய் பார்த்தோனே ஒரு 25 இருக்கும் கரெக்ட்டா பட் L&T ல என்னென்ன business இருக்கு anybody can tell so you have a EPC company which is what core L&T then you have a shipbuilding la போயிடுச்சு சார் அதெல்லாம் வந்து நீங்க வந்து 10 years பின்னாடி இருக்கீங்க IT is a very separate company they have few company they bought out few more companies they have one more company financial services கரெக்ட்டா என்னைக்குமே அந்த ஸ்டாக் நல்லா பண்ணது இல்ல கரெக்ட்டா ex-employee, I know that. அதுக்கப்புறம் ஹைதராபாத் மெட்ரோ ஒரு செப்பரேட்டா அந்த ஒரு பீஸ் எல்லாம் வச்சிருக்காங்க they have a so you have a company EPC ஒரு finance ஒரு lending நம்ம வந்து ஒரே ஒரு P ratio போட்டு சொல்லிடலாமா இல்ல so every analyst do something called SOTP where EPC has to be separately valued IT has to be separately valued and eventually financial services will be valued by price to book. So info edge-க்கும் அந்த மாதிரி தான் கரெக்ட்டா yes okay it's a good question he asked Balaji banks la kuda insurance idellame irukku idellame irundhalume yes like Kotak bank or sila banks ku neenga SOTP ulla poduvinga but most of the bank la bulk of the profit is coming from the banking so being little lazy no you make everything price to book. See, we are lazy people. With Swiggy, Zomato, what else you can expect? Don't you think we have become lazy? 100%, right? So, lazy economy will do very well. If you are starting a business, please align yourself. Oh, okay. See, எந்த கம்பெனிலயுமே நம்ம டிசிஷன் எடுக்க முடியாது கரெக்ட்டா because even you vote no you are a minority investor கரெக்ட்டா every resolution will be passed in India. Agreed or not agreed? It is passed unanimously. Yes or no? So, that is one problem normally. In holding company, you don't even have any control on the other company, right? What do they do? So, market tend to give a discount of 50-60%. They'll always have a discount. So, when you buy a holding company, you should buy a good holding company. It means on the end company, that should be a good horse. If that's a dead horse, no, don't even go there. So what multiple miss is, multiple compresses information, it's a shorthand form, it is good to have judgment but multiple doesn't explicitly tell everything. So you need to know, it's a very shorthand form of valuing a company. என்னால DCF எல்லாம் பண்ண முடியாது இந்த terminal growth எல்லாம் பண்ண முடியாது பாலாஜி அவ்வளவு டயர்டா இருக்கு so you take a PE PB but you should know it's a shorthand form and not a full form of doing it. Instead of we doing a cooking full meals we are doing a Maggi correct but we all love Maggi. Okay why one of the question was asked is why one valuation method is not good to judge any index. So nifty enna nam first thing enna solluvom nifty P ratio okay yes sir illa I'm coming nifty enna P ratio correct ah but nifty la evlo variety of companies irukku recently two new companies came in nifty what are companies Zomato Jio let's take these two companies Zomato ku நம்ம என்ன valuation பண்ணுவோம் PE பண்ண முடியுமா PB PS இல்லனா ஏதோ ஒன்னு பிரைவேட் மார்க்கெட் உங்களுக்கு தெரியாத சட்டம் ஒன்றும் இல்லை கரெக்ட்டா எஸ் ஜியோக்கு என்ன பிசினஸ் இல்ல see when someone says no nifty P is 20 are costly I said wait ரொம்ப அந்த obsession வேணாம் nifty P ஒரு நல்ல நம்பர் தான் நல்லா இருக்கு நல்லா பார்க்கலாம் ஜெஃப்ரிஸ் வாரம் ரிப்போர்ட் எழுதுவான் everyday you get report that everyone knows first of all we should know what the 20 means 20 means nothing எதனாலனா this is the first time I did the exercise thanks to Vignesh for the session I never did manually I know intuitively running a large cap fund the variety of companies in nifty is a crazy thing friends there are 11 company where you do EV by EBITDA right which is economic value divided by EBITDA because lot of depreciation interest எல்லாம் இருக்கு then there are some 7-8 company you will do price to book value including Jio I don't know what Geo does it, but it's financial services, so you do PB. Then there is a 20 company, you will do PE ratio. Correct? You're aligning. Anga motta dhaan neenga align aaringa. Adukapparam there is something called price to embedded value, which is life insurance. Avanu vandaachu namalkulla. This was not even there 6 years before. Correct? But still nama Nifty PE pudichikittom. Then there is something called PS. First time Nifty la PS vandirukku. So I think we should definitely know because of Zomato name has changed. Now first I was trying to see, that should be the last one, no? அப்புறம் தான் பார்த்தேன் நேம் மாறிடுச்சு இட்டர்னல் அப்படின்னா லைஃப் லாங்கா. So you know where they are going, right? Terminal value. Exactly. Analysts வந்து they were thinking about punching what growth rate? Eternal அப்போ 25 years growth போடலாம். And the last thing is some 7-8 company SOTP. அதுல சில கம்பெனி SOTP எல்லாம் போடவே முடியாது. அது என்ன நம்பர் கொடுக்குறாங்களோ நம்ம எடுத்து போட்டுப்போம். இது எல்லாத்தையும் வச்சு நம்ம நிஃப்டி 20 PE அன்றோம். So don't get very, very obsessed when someone says 20 has become 21, marks have become very expensive. It's time to sell and trim. Rs 19. Boss, it has to be very, very nuancedly thought about. Nifty name doesn't change, friends. Nifty changes. Do you agree? And the pair motana maarala, micha ellame maaridudhu, right? So PE in a context has to be seen, used. Blindly we see, we can write very good reports, but we can't make money. And our end job is to make money for less risk, correct? So this is the ROCE profile of Nifty 50 company. The right on the top left is Maggi, Nestle. Then comes TCS, then comes HUL, like my good friends. Can you see the last two culprits? No. They are good companies. So far not reporting any operating profit. They are futuristic. This is the Nifty, right? So Nifty has all the variety in life. So don't get stuck. It doesn't mean Balaji solta 25 P kuda P doesn't matter. P gives you relevance and the constraint to purinji number decision edutha, we can always take very high quality decision. That is my whole submission about this relative valuation. Okay, I think drivers of value, what creates value? Simple. ROCE, working capital, which we have already spoken, that's one. Robustness of business. This I have taken from Pulak Prasad book, what I learned from Darwin. ஒரு business எப்படி இருக்கணும், ஒரு business எப்படி இருக்கக்கூடாது. Delivered historical ROCE. So you should see whether your company have delivered against high operating loss. Don't ever get here. Fragmented customer base. Last 3 years, the companies did very well with one customer, which is government, correct? Adu luck. If you consistently want to make money, you need to find a business where 1 crore customer buying the product and not only one customer. No debt, high entry barrier. Yet, Bharti Airtel was easy, no? Even though entry barrier technically not there, there is a big barrier to come into telecom. What is the barrier? Who said? Spectrum will run into lakhs of crores. Next time, ground rules. No unnecessary conversation. Industry is slow changing. It means industry should be like a tortoise. Very boring. No excitement. It means like ITC. COVID வரும்போது என்ன சொன்னாங்க? மக்கள்லாம் மாறிட்டாங்க. சிகரெட் பிடிக்க மாட்டாங்க. What happened? ITC stock went all time after 2 years, correct? So certain things doesn't change. Maybe I don't subscribe to it, but I'm saying some things are like that only, right? So we gamble, right? Indians gamble now. We gamble a lot more than ever gambled. So robust business we have to choose against driver 2. Driver 1 we know EVA should be positive. Driver 2, business should have this character. The last one, how you mix it? You get the sales. Sales will grow by volume, price. You get operating leverage, which is spoken in the morning, right? You build the asset, sales varumbodhu operating leverage varum, economies of scale. Companies should cut the cost. Today, this is even more important to cut the cost. Why? With the tariff coming in, if your customer is not willing to pay more, who has to pay? You have to pay. And finally, investment, right? Once you put the asset, you have to bring productivity. One company, 10 years back they put the assets, still they have to get the productivity. So what will happen to the stock price? Will go down, right? So all these three drivers of value. This one? This is basically on the EVA model. You have to create value. You have to find companies with the left side, not the right side. And finally, நீங்க excel பண்ணீங்கன்னா, these are the drivers, right? Sales has to grow, price and mix. Why FMCG trades always high multiple? No. This is the reason. Price and mix. Can anybody tell what is Rin Shakti price 10 years back and today? Any small anecdotal evidence? Size kammi edicha? It means it has gone doubled. But do we notice the price? The answer is no. What is a 1 kg price of a Colgate? Na Balaji, 1 kg eல்லாம் கேக்குற? Right? We don't even know, right? Beauty la, the buyer doesn't even know the price. I just buy and paste it, correct? Twice a day, thrice a day, 4 times a day. 600 rupees is per kg. Kids paste na 1200 rupees. That's the price. But we don't even see, that's a reality. This is why HUL trades at 40 means there is a reason. I know. So there is a good correlation between PE and EV by EBITDA. It means generally higher the PE, you will see higher EV by EBITDA because they both are highly correlative assets. I'll skip this, but basically very few scenario where PE and EV by EBITDA can be same. The scenario is simple. The company should not have any capital to invest, which is like an asset management company. Company should not have any debt. Company should have completely no depreciation. Then EV by EBITDA and PE also will be similar. The one question you asked, which is the most important, is we know PE, but when the PE will get expanded. Why did Bajaj Auto went from 20 to 44? Is a question, right? Because that's how you make not money. You make a lot of money. So there are only 5 variables which I have pinned out. The first variable is duration of the growth going higher. Higher the duration of the growth. Next, the quantum of the growth. You understand the duration? Instead of 10 years, the company is going to grow 30 years. Then your PE multiple will expand. Like the name got changed, Zomato to Eternal. Correct? Second, the quantum of the growth goes up. Instead of growing at 10%, the company started growing at 15%. The quantum. Third, reduced capital intensity. Amazon moved from a very capital business to capital light by getting into what? Exactly. See, AWS is not only one more business. It's a business which needs less denominator. Correct? Multiples expanded. Fourth, reduced volatility of the growth. It means company consistent 12% grow agudhu. So do you have any risk? No. Appo and the beta vandu kammi aidum. Neenga kettingla the denominator that will go down. Pidilite beta is less than 1. Why? Very consistent, not for 10 years, for last 30 years. And the last one, reduced equity risk premium, which is on the country or the risk premium kammi ago, which is what is happening to India. Why? India is the only country where our fiscal balance sheet is extremely good. Our policies are very, very consistent and we have a stable growth. So slowly and steadily, and the risk premium konju kammi agum. That is why you will see always Indian valuation will be higher than every other market in the world. So these are the 5 metrics when the PE will expand. The opposite will be the PE will come down. Correct? So I've just done an example. I don't know if you're able to see the number, but I'll just call out. Growth 0, terminal growth 0, discount 0, 10 PE. It means 0 growth, discount rate 10%, the PE is 10. Correct? Mathematically, that's it. The moment I increase the growth rate to 10%, first 15 years 10%, terminal growth 0, discount rate, the PE will move to 20. So from a 0 growth company, you gone to 10% growth for 15-year period. The PE moved from 10 to 20. You're able to get? This Because all slides are continue. It means I'm going to start with 20 in the next slide. The first thing is quantum of the growth increased. Do you agree? From a 0, you moved. This is what a good investing can happen. You buy a stock with a 6% growth and the stock delivers 10%. No, you make very good money. This is my favorite principle I applied. Those who remember Jyoti Labs, a couple of years back I presented, was a similar case study where the market assumed 6%, I assumed 14, and Jyoti, which is the CEO, MD, did 14, and the stock went up 2x. So from 20, the duration of the growth from Zomato to Eternal, I mean not by name change, by numbers, the terminal growth which is 0 has gone to 5%. Can you see now too? Growth 0 to 0, 10 and 0 ache. Now this 10 is there, but this 5 also I included. The duration is got extended. The P moved from 20 to 31. Can you see? 10P gone to 20 to 31. Reduced beta, where the disk exactly, right? Finally, the company become very better. The investor is saying, I am super confident about they're doing it. I will reduce my risk by 1%. Look at the difference. 10 has become 9. The 31 has become 39. So, a 10p stock going to 40p is possible when you buy a stock with a 0 growth assumption. First they do 10% growth, then they get the terminal growth. They get it so consistently, the beta goes down, it becomes 40p. You hit a multi-bagger. Do you agree? This is how PE multiple expands. Today actually I should teach you how PE multiple contract, which I don't want to do, but you know that, right? Because all the stock now trading at 40 should come to 20, correct? But that's a sad story which you will do it. I don't want to. But this is mathematical way. When growth higher, growth longer, risk lower, multiple expands. The opposite, when it happens, the multiple contracts. Finally, I'm coming to the end game, which is why did we do what we did? Such a boring way, right? Let's see. 3 objectives, and this is my primary objective. How to choose a winning stock with the best risk to reward using various tools. That's my objective, correct? The second one is also very important. How to overcome the bias of investing only in low PE stock. It means I want to invest even slightly not a low PE stock. And the last bias which I want to avoid is how not to avoid great company just because of starting valuation. If I achieve all these 3, I think I did a decent job. That's my end objective. I hope. So, to become great investor, you have to do only 2 things. One, you do your independent valuation, but you also take market feedback. A good investor takes both, so you become great investor, correct? So when a 10 becomes 20, don't go and sell because you made money. If the market wants to give you 40p, please take it with both the hands, correct? That's how it happens in bull markets. So our job is to bet against the better. So we value one. We also have to find where the bets are misplaced, correct? This is nothing to do with the stock. It's with the market participant. How did you value? How did you value? Now how I am supposed to value, correct? So if you see horse 3, the bet is wrong. The applied odds are 14%, but actual winning ratio is 20%. So you know it is not a great horse, but the bets are misplaced. So our job as an investor is not to find highest growth stock. That's not the job. Or the most popular stock. No. The stock where the market is having one assumption, I have a different assumption and I am right. Then you are going to make a lot of money. So this is one such company where high PE people paid still made decent money. Which is the company? Look at the power of e-commerce. Annual report, 2000 annual report. Any guess? Amazon. This is an Indian company. Which one? Mastek. Has Mastek made so much money for shareholders for 25 years? This is Infosys. I was surprised to see the first line, the power of e-commerce up away. Now they are writing power of AI, correct? Very interesting, a very low probability case of a high P stock, how it performed. So the starting P in 2000 was 200. Appa Zomato cheap aidumla. I don't know what is Zomato PE. So the Infosys PE was 200. Their profit was 285 crores. The market cap was 60,000 crores. அப்பவே 60,000 crores. எந்த அளவுக்கு fraud இருந்திருக்கும்னா very big. But very interestingly, when you do a reverse DCF, market has penciled in 40% growth, 10% growth and terminal growth of 5% for 12%. So when you do this, the market cap is 60,000 crores. It means 40% growth for a long period. Generally not possible, correct? So if you look at the assumption, 285 has to become 399, 559, 782,000. It becomes 13,000, correct? It looks very stretched, no? 285 to 14,000. But if you bought a great company, very exceptional, don't think, not even one company will do like this. Their actual profit was very close to the assumptions. It means market exactly saw this company can grow at that rate. And the end outcome, no. Even though you bought 200 PE, you still made market return on an average, which is not a bad outcome for a 200 PE stock. This is not an example to go and buy 200, but some company when at 50 PE, people don't want to buy because it's 50. When you go back and see the data, right, they've done create significant wealth. I think Infosys taught us some companies, very few company can grow from 285 crores to 12,000 crores in a 20-year period, 15-year period. Very rarely, correct? This is one hurdle which we all should cross. This is little easy. The toughest job is this. When cheap is not cheap. This is what I personally gone through a lot of times, bought a small cheap company, never made money. This is none other than Bajaj Consumer. Do you know the product? They only sell in their own office, looks like, right? Look at this. The stock was 14p, FMCG company. எப்படி இருக்கும்? சுபாஷ் என்னடா HUL 50 என்றான். இங்க FMCG 14p, கரெக்டா? See, it's mouth watering, no? FMCG, debt free, 14p. I thought my jackpot has hit. சைலண்டா நம்ம வாங்கிப்போம், யாருக்கும் சொல்ல தேவையில்லை. யாருக்கும் நீங்க சொல்லவும் முடியாது, கரெக்டா? Yes or no? See, the reality, no, everybody does mistake. The only question is, at least you should know, right, you have done a mistake. I have never done this mistake. I invested in one more parallel company for 10 years, zero return. That's called Agrotech Foods. That's another popcorn story. So the assumption was, this company only will grow 8% for 10 years. After that, it doesn't grow at all. Anga Infosys assumption pathana 40%. Inga 8%. Assaulta grow illalla. India is a growth economy. Modi also told Viksit Bharat 2047. But what has happened? No, India will grow. Whether Bajaj will grow is the question. If you see, the company did close to the assumption till 2018. So from 120 crores, now they are doing 130 crores after a decade, 15 years. Huh? Disaster in the making, right? They have given for a 10-year 40 PPTs. And they have done 40 con calls. So you can listen, read. You feel very enthused when they say, right, we have put the strategy. Next year, the oil number kandipa vippon thalala mudiyala na oil vippa. But that is their story. But you see the number, no, such a sad number. And you know the outcome. I have already told how a 14p stock gave a 0% return in a growth economy like in India is a case study to study for everybody. No, it's a case study. Simply investing in index fund, you did 12% compounded. Every 6 years, you doubled your capital. After 40 con call, 40 AGM, 40 annual report, so much of hair oil product, at least you use pannirupinga. Still, there are more than 1 lakh shareholders in this company. I don't know what they are doing, but something which we should learn, right? So, even an 8% hurdle this company did not cross. Infosys crossed a 40% hurdle. All it means is, if you found a real gem which is growing at that pace and continue to it, don't just sell because it's 50p, boss, no. Same thing, you stuck with the 20p stock, not at all progressing, and actually progressing reverse, no. 20p is also costly, not necessarily cheap. That's my learning out of this entire, this one. Summary, no one size fit all method. Match valuation method with the character of the company. Every company is very unique. There is no two similar companies for us. Blend methods of valuation to do triangulation. So maybe use PE, DCF, PB, PS to find the value. Narrative is key to valuation. Different narratives can lead to different valuations finally. And finally, value is a function of quality of growth, quantity of growth, and longevity of growth. With that, I will end. Thanks for the patient listening. Hope we all make good money with less risk. Thank you. And thanks to a lot of people. I have fully copied, learned, used reference. So people want to see. It's all obviously right. A lot of material has been used. Thank you for being very patient. Any questions, or we can take it out to say.
Thanks, Balaji. Request Mr. Bhaskar, member of TR, to come and honor the speaker.